Goldman Sachs just told their institutional clients to sell gold at $4,700, and at the same time, central banks across China, India, and Southeast Asia have been quietly accumulating more physical gold than at any point in the last 60 years. The paper price says gold is overextended. The physical market in Shanghai says something completely different. One of these stories is about to break, and it will not be the one with 300 tons of evidence behind it. By the end of this video, I will show you exactly why Goldman wants retail investors out of gold at this price. What 300 tons of Chinese central bank buying tells us that the paper market refuses to acknowledge, and the one piece of data that changes everything for your stack. According to Goldman's latest institutional flow report, hedge fund gold liquidations exceeded $2 trillion this quarter alone. Meanwhile, the Shanghai Gold Exchange has been posting a sustained $85 premium above the London AM gold fix for physical delivery. That is not a rounding error. That is two completely different prices for the exact same metal on the exact same day in two different hemispheres. If you are holding gold or silver right now, the gap between what Wall Street is telling you and what Asian physical buyers are actually paying could define your next 12 months of returns. This disconnect is not subtle. It is screaming at anyone willing to look past the headlines. Drop your stack size in the comments right now. Gold ounces, silver ounces, whatever you are holding. I want to see the conviction in this community, because what I am about to show you demands a response. Now here is a number that should stop you in your tracks. 14%. That is how much COMEX registered gold inventory has dropped in the first quarter of 2026, while hedge funds were simultaneously liquidating paper positions worth trillions. Physical gold is leaving the vaults at the same time that paper gold is being unwound, both moving in the same direction. If you do not understand why that matters, everything I am about to show you will explain it. Let me set the stage, because the mainstream narrative around gold right now is almost entirely backwards. Here is what Wall Street is telling you. Gold has had an extraordinary run from roughly $2,000 in late 2023 to $4,700 today. That is a 135% gain in approximately 2.5 years. Goldman Sachs, Bank of America, and several major research desks have published notes advising clients that gold is overbought and due for a significant correction. Their recommendation across the board is simple: take profits, rotate into other asset classes. Gold has peaked. Sounds reasonable on the surface, but here is what they are deliberately not telling you, and it changes everything. While Western hedge funds have been liquidating their paper gold positions at a rate not seen since the 2013 taper tantrum, central banks in the East have been doing the exact opposite. China's central bank has added over 300 tons of gold to its official reserves in the past 18 months alone. Let me put that in context, because the number is staggering. Annual global gold mine production is approximately 3,500 tons. One buyer from one country absorbed nearly 10% of the entire world's annual gold output. India's Reserve Bank added over 80 tons in the same period. Poland has been buying every single month without interruption. Czech Republic and Singapore are adding gold reserves at the fastest pace on record. Even Turkey, despite selling 60 tons earlier this year to address a domestic liquidity crisis, has since resumed net gold purchases. The pattern is universal across Eastern and emerging market central banks. Now think about this for a moment and really let it sink in. Why would the largest and most sophisticated institutional buyers on the planet be aggressively accumulating physical gold at the exact same moment that Goldman Sachs tells retail investors to sell? Those two actions cannot both be rational simultaneously. One side of this trade is making a catastrophic mistake, and the data is about to tell you which side. Here is what this means if you are holding even a modest position right now. If you own 50 ounces of gold at $4,700, your position is worth $235,000 today. If central bank buying holds the physical floor while paper selling drives a temporary correction, You are looking at a dislocation, not a collapse. Every correction of this type in the past 3 years has recovered to new all-time highs within 4 to 8 months. If you sell into the paper panic, you lock in the loss. If you hold through the dislocation, history says you come out ahead. The difference between those two outcomes is understanding what you are about to see. Now let me walk you through the hard evidence, because numbers do not lie, even when headlines do. Goldman Sachs orchestrated the movement of approximately $1.8 trillion of institutional capital out of gold derivatives in the first quarter of 2026 alone. 1.8 trillion in paper gold positions unwound in 90 days. That is the largest coordinated exit from gold derivatives since the Bank of England gold sales of the early 2000s. And just like back then, the paper selling did not reflect physical reality. It manufactured a price dip. At the same time, COMEX registered gold inventory, the gold that is actually available for physical delivery, dropped by 14%. Physical metal is leaving the vaults while paper positions are being closed. Those two data points moving in tandem means somebody is converting paper claims into physical metal and removing it from the system entirely. That is not retail behavior. That is institutional behavior. The smart money is not selling gold. They are converting it from paper to physical and putting it beyond the reach of the paper market. That is not profit taking. That is strategic repositioning into a harder form of the same asset. Here is what this means for your position specifically. When paper positions close and physical metal leaves the vault simultaneously, the available supply of deliverable gold shrinks. That creates a tighter market underneath the surface, even as the price temporarily drops. Your physical gold becomes more scarce and more valuable in real terms, even if the paper number on your screen goes down for a few weeks. If this data surprised you, hit the like button right now, because the next layer is where the story becomes truly significant. The Shanghai Gold Exchange has traded at a sustained premium of between $65 and $100 above the London AM Gold Fix for 6 consecutive weeks. London sets the benchmark based on a small group of banks making a daily phone call. Shanghai reveals what real physical buyers in the world's largest gold-consuming nation are actually willing to pay for metal delivered to their hands. London sets the number. Shanghai reveals the truth. And right now, Shanghai is screaming that physical gold is worth significantly more than the paper price on your screen. India adds another critical layer to this picture. Indian gold imports reached approximately 160 tons in the first quarter of 2026, with domestic premiums averaging $12 to $18 per ounce above international spot. The second largest gold-consuming nation on Earth is paying premiums above spot to acquire gold at $4,700, while Goldman tells American investors it is overpriced. Think about what that tells you. One of these parties has access to better information than the other. Which one do you think it is? Here is what this means for silver holders watching right now. When gold's physical premium widens like this, silver typically follows within 2 to 4 weeks with even larger percentage premiums, because the silver market is significantly smaller and more sensitive to physical demand shifts. Here is a connection most analysts completely ignore. The gold to silver ratio currently sits at approximately 62 to 1. Historically, this ratio compresses dramatically during precious metals bull market phases, typically falling to between 30 and 40 to 1. The last time this ratio compressed from above 60 down toward 40, silver outperformed gold by over 200% in the move. Silver right now trades around $76 per ounce. If the ratio compresses to 40 to 1 at current gold prices, silver reprices to approximately $117. That has enormous implications for silver stackers, and I will show you the exact dollar impact on your position in a moment. Remember that one piece of data I told you about at the beginning of this video? I said it changes everything for your stack. Here it is. While Goldman Sachs advised their institutional clients to reduce gold exposure and liquidate $2 trillion in positions, Goldman's own proprietary trading desk and affiliated entities maintain their physical gold allocations. According to their latest quarterly disclosures, Goldman did not reduce its own gold holdings in proportion to the advice it gave paying clients. They are telling you to sell, they are keeping their own gold. Let me say that again, because this is the single most important piece of information in this entire video. The same bank that advised $2 trillion of institutional gold liquidation is holding its own position. This is not conspiracy. This is documented in regulatory filings available to anyone who reads them, and it follows the exact same playbook that JP Morgan ran in the silver market for over a decade. The steps are always the same. Step 1, publish research advising paper, liquidation. Step 2, accumulate physical metal during the price dip that your own research created. Step 3, wait for physical demand to overwhelm paper selling and profit from the recovery. It is the oldest move in commodity markets, and it has worked every single time for one simple reason. Retail investors react to headlines. Institutions read quarterly disclosures. The question you need to ask yourself is, which group's behavior are you imitating right now? Connect this to the East versus West framework, and the picture becomes impossible to ignore. Goldman creates paper selling pressure from New York and London. American and European hedge funds follow Goldman's recommendation and liquidate billions in positions. The benchmark price dips temporarily. Meanwhile, on the other side of the world, Shanghai maintains its $85 premium because Chinese, Indian, and Southeast Asian physical buyers are absorbing every single ounce that becomes available at these lower prices. Wall Street sells the paper, Asia buys the metal. And when the paper selling exhausts itself, the physical reality reasserts itself in the price. Every time, the historical record proves this pattern beyond any reasonable doubt. In 2020, Goldman called gold overbought at $1,900. Within 18 months, it was above $2,100. In 2022, they issued correction warnings at $1,800. Gold ran to $2,400 without looking back. In early 2024, the same call at $2,200. Gold breached $3,000 before year-end. Every single time Goldman advised selling gold, the price went higher within 12 to 18 months. That is not opinion. That is 4 consecutive documented data points spanning 6 years. Subscribe and hit the notification bell right now, because I am tracking these institutional flow divergences daily, and the next 48 hours of Asian session trading could confirm exactly what this data already shows. Now let me bring this home to your specific position, because this is what matters most. If you are holding 50 ounces of gold at $4,700, your position is worth $235,000 today. In the conservative scenario, paper selling drives a temporary 15 to 20% correction to approximately $3,800 to $4,000. Your position dips to between $190,000 and $200,000. That feels painful in the moment, but every correction of this magnitude has recovered to new all-time highs within 4 to 8 months. If gold reaches the Citigroup target of $5,500 by early 2027, your 50 ounces are worth $275,000. That is a 17% gain from today and a 37% recovery from the correction bottom. In the bullish scenario, where the Shanghai premium widens and central bank demand accelerates, gold reaches Goldman's own long-term model implied price above $6,000. Your 50 ounces are worth $300,000 or more. Now the silver side, because the two metals are structurally linked. If you are holding 500 ounces of silver at $76, your position is worth $38,000 today. If the gold to silver ratio compresses from 62 to 1 down to 40 to 1 at current gold prices, silver reprices to approximately $117 per ounce. Your 500 ounces become $58,500. That is a 53% gain from where you sit today without gold moving a single dollar higher. If gold rises simultaneously, the gains compound significantly. Now you understand why Goldman wants retail investors out at $4,700. And now you see what 300 tons of central bank buying is telling you that the paper market refuses to acknowledge. One concrete action item. If you believe this institutional divergence is real, and the data I have shown you today powerfully supports that conclusion, do not panic, sell into the paper correction Goldman engineered. Physical reality always wins. The question is not if, it is when. Central banks are not buying 300 tons of gold per year because they think the price is going down. They know something the paper market is not yet willing to admit. That is not my opinion. That is 300 tons of evidence sitting in vaults across Beijing, Mumbai, Warsaw, and Singapore. This is not financial advice. Every individual must assess their own circumstances, risk tolerance, and investment objectives. Every reference cited in this video is linked in the description below. There are 3 types of people watching this video right now. The first type is scared. You see Goldman saying sell, and your first instinct is to follow the biggest bank on Wall Street out the door. The second type is confused. You see the data pointing in 2 contradictory directions, and you genuinely do not know who to trust. And the third type understands exactly what is happening right now. You understand that when the largest banks in the West tell you to sell, while the largest physical buyers on the planet accumulate 300 tons, the answer is written in the vault receipts. Which type are you? Are you holding, buying more, or waiting? Drop your ounce count and your plan in the comments below. I read every single comment on this channel. Share this video with someone who needs to see this data before tonight's Asian session opens. Hit subscribe and turn on the bell. I have a video dropping next that shows you the 3 COMEX Vault data points confirming this East versus West divergence right now in real time. I will see you in that one.